Hello, good morning, good afternoon, or good evening, depending where you are in the world, and welcome to this webinar on incorporating ESG into investment strategies. I am Bérénice Lamblin, conference producer at Climate Action. Thank you for joining us. It's a pleasure to welcome so many listeners to this afternoon's webinar. We have received over 600 registrations, so it's a bit of a full house and a testament to the excellent speakers we have participating and the importance of the subject area. Please be aware that this session is being recorded and a link will be emailed to you shortly after the webinar is complete. So you will be able to listen again and share with your colleagues if you wish. Just to let you know a little bit about climate action, for the last 10 years, we have worked in a unique partnership with UN Environment to develop their official publication and events. This is with the aim of establishing partnerships between the public and private sectors to accelerate green economic growth. Today's webinar takes place ahead of the second annual Sustainable Investment Forum, which is organized in official partnership with the UNEP Finance Initiative during Climate Week in New York on 19th of September. The forum will gather asset owners and managers, commercial banks, development banks, private venture capital, technology developers, mayors, and regional policymakers. Currently, speakers include Howard Banzi, Executive Director of the Green Climate Fund, Betty Yee, California State Comptroller, Philippe Desfossés, CEO of the pension fund Retraite Additionnelle de la Fonction Publique, or ERAF, Raymond Johansson, Mayor of Oslo. Please do visit sustainableinvestmentforums.org for more information and to download the full agenda. Which brings me to today's webinar on incorporating ESG into investment strategies. The sustainable and impact investment sector has grown significantly in the last few years. $8.72 trillion of assets now incorporate ESG factors in the US, which is 33% more than in 2014. However, ESG investment still needs a more robust structure and clear-cut regulations, as well as more established principles in order to scale up further and appeal to more investors. Asset owners and asset managers need to enhance their understanding of how to incorporate ESG factors into their investment strategies while reducing risk and maximizing profits. Over the next hour, we'll explore the following questions around ESG investing. What are the drivers for considering ESG factors? How can asset managers and investors successfully incorporate ESG into their portfolios? And what are the various strategies? How to analyze financial risk and return when applying ESG strategies. I feel extremely privileged to welcome three excellent speakers this afternoon to address this topic. Firstly, we welcome Eric Usher, who is head of the UNEP Finance Initiative. Eric has 25 years of experience in the sustainable energy and finance sectors, including an entrepreneurial venture in Morocco, financial sector development across emerging markets, and responsible investment uptake globally. Eric will be our first speaker, talking about the progress that responsible investment has made globally and about the new principles for a positive impact finance to create a common framework to finance SDGs. We're then joined by Brian Rice, who is the portfolio manager in the corporate governance department at the California State Teachers Retirement System, or CASTES. His main area of focus is integrating sustainability considerations into CASTES investment processes. Brian also leads CASTES sustainability-related engagement efforts, and he's the staff lead for the CASTES Green Initiative Task Force, which is a multi-asset class team charged with identifying, implementing, and reporting on environmental investment opportunities and risk management strategies. Brian will discuss CASTES' history of ESG investments and how ESG were integrated in the organization's processes. Finally, we're joined by Frederick Samama, Deputy Global Head of Institutional and Sovereign Clients at Amundi. Amundi focuses and directs their expertise towards achieving performance from sustainable sources. They are so committed to this approach that they integrate ESG criteria into all of their management processes. Amundi, in partnership with the World Bank's private sector investment arm, the IFC, have recently agreed to form a $2 billion green bond fund to help provide more financing for low-carbon investments in emerging markets. Frederick will explain why and how asset owners are increasingly considering climate change-related risks and what role Amundi plays in this growing sector. Each speaker will take 5 to 10 minutes to present their views, following which we will take questions from our listeners. You can submit your questions via Twitter using hashtag #Scene17 or using the question box on the GoToWebinar bar to the right of your screen. Please don't be shy. We will try and get through as many relevant questions as possible in the hour time frame. And with that, I shall now hand over to our first speaker, Eric Asher. I'm just going to unmute you, Eric. So, Eric, the floor is yours.
Great. Thank you very much, Bernice, and appreciate the opportunity to speak. So the Unit Finance Initiative, for those who don't know, it's a global partnership between the UN and a large grouping of financial actors. Actually, about 230 of the larger banks, insurance companies, and some asset managers working together to collectively develop the notion of sustainable finance. We were founded by a group of banks and fund managers at the Rio Summit. This is actually our 25th year anniversary. Globally, there's roughly in the order of about $23 trillion of assets being professionally managed under the notion of responsible investment strategies. This very significant figure tells us that participating in a conversation on environmental, social, and governance factors has definitely become a necessary part of the mainstream investment community. Now, we define ESG integration as a systematic and explicit inclusion of material ESG factors into investment analysis and investment decisions. Essentially, ESG integration is about long-term value creation. It's about prudent investment. Now, there's been a lot of progress in industry practice, in policy and legal frameworks that demonstrate that failing to invest responsibly with explicit integration of ESG in investment decision-making is a failure of fiduciary duty. And as some on the line might know, that historically it was 10 years ago that the Freshfields report was the first analysis was undertaken by a group of our asset managers that looked at the notion of fiduciary duty in terms of responsibilities in investment decision making. That was what led to the establishment of the Principles for Responsible Investment. Today we have an ongoing program with the PRI furthering the understanding of fiduciary duties, and a lot of it is around awareness raising and understanding the implementation of within different legal jurisdictions, the interpretation of how fiduciary duties applies to investment activity. And I'm going to change gears, if I can go to the next slide, to talk about the climate imperative and the notion of what we see as what essentially is an unstoppable transition to a 2-degree economy. It's unstoppable in political terms. It's unstoppable on economic and financial grounds. Now, in the unfortunate, the aftermath of the decision of the U.S. administration's decision to withdraw from Paris, what we have seen is certainly an upsurge of activity in terms of governments from both the developed and developing world, as well as many political leaders at city, state, and country level, from within these, including from within the United States itself, are showing leadership to move forward. In fact, all other major greenhouse gas emitters, including the European Union, China, India, Japan, Australia, and Canada, have reaffirmed the importance and validity of the Paris Agreement. Institutional investors, including those from the U.S., continue to implement efforts to align their core portfolios with the low carbon economy. This is still a new area of work, but the impetus to move forward continues to grow. In this year, in 2017, the Portfolio Decarbonization Coalition, which we co-managed with CDP and which was co-founded by Amundi, and Frederick Smama was core in leading that work in the lead up to the Paris Summit. In this year has welcomed 2 interesting new members, and members essentially commit to take action to decarbonize their investment portfolios. The new members are the New York State Common Retirement Fund, which is the I believe the third largest pension fund in the U.S., and they became the first major public pension fund in the U.S. to set a decarbonization target in joining. And secondly, the Unilever Pension Fund, which is the first corporate pension fund to join up to the PDC. So investor action towards decarbonization, we see it continuing to grow. Next slide, please. So what is increasingly clear is that climate action and sustainable development more broadly are not seen so much as a burden. More, they're being represent more of an unprecedented opportunity. within the finance sector, there's an increasing realization that the times are changing, that issues such as population growth, robotics, and digitization are all pushing at or impacting on planetary boundaries, and that this does not simply constrain the market, it really helps define it. So what we're witnessing is the rise of large emerging economies in the green finance space, the interest from private sector players in areas like green bond issuance, and Fred's going to talk about that later in the call. The notion of blended finance, public and private, and the aspects of impact investing are all growing. The sustainable development market is huge, and if you think about, roughly 5 to 7 trillion a year is needed by 2030 to realize the SDGs worldwide, including investments in infrastructure, in clean energy, in water, sanitation, agriculture, just to name a couple areas. The greater part of the necessary financing investment will need to come from private finance. And the real question is how. In January of this year, UNIPFI launched in Paris the Principles for Positive Impact Finance. And this is essentially an initiative aimed at bridging the funding gap for sustainable development and the attainment of the SDGs. And the notion that we require some form of new impact-based approaches centered on a more holistic consideration of the 3 pillars of sustainable development. Now, with the launch of these principles, we essentially see ourselves moving into the area of impact. Impact was not a notion that has been invented by UNIPFI. It's been around for some time. But with these principles, the ambition is to take it to the mainstream. So it's with this view that a grouping of our members, and we see some of them on the slide, which includes banks and investors, have seen that tomorrow's business models and companies will revolve around impact. They will specialize in mobility and energy efficiency and water efficiency. Financial institutions need to start looking at sustainability as a strategic issue, a new way of looking at business. They have a direct interest in ensuring that their client and investing companies are steering the course of innovation as we enter the 4th industrial revolution. Now, the principles of positive impact finance build on an existing framework, such as the PRI or the green bond principles, and essentially provide some sort of a common language to the finance community and for the broader set of stakeholders to capture the SDGs investment opportunity. It's essentially trying to define what is SDG compliant finance or relevant financing. So if we can take a look at a little bit more detail at the principles. Next slide, please. There are 4 principles. Now, as compared to other frameworks that are out there, this is quite a bit broader. And essentially, the principles apply across all categories of financial instrument and business activities that underpin them, including bonds, loans, equity, infrastructure, real estate, etc. So it's quite broad. Principle 1 is the definition of what we mean by positive impact finance, and essentially finance that delivers a positive contribution to the environment, society, or economy once potential negative impacts to these 3 pillars have been duly identified and mitigated. So it's the pluses plus the negatives added together. Principle 2 on frameworks is the how. It translates the definition into what needs to happen inside institutions in terms of establishing the dedicated processes, the methodologies, and the tools to identify and assess positive impact businesses and activities. This would be sort of akin to what we talk about as green tagging, the systems you need to have within your organization. Principle 3 is on transparency, provides a guarantee of the robustness of their principles overall. And Principle 4 on assessment provides guidance on how to evaluate financings and financial instruments based on the first 3 principles, meaning essentially that the financial instruments or the securities, the funds, indices, etc., can ultimately be verified, certified, and rated. So the positive impact strategy, next slide, please. Since the launch of these principles, essentially there is 3 broad channels that have been set up for action. The first is at the individual level, where financial institutions are starting to work on issuing different types of products and services. For instance, last week, someone may have seen that Société Générale in France have launched the first positive impact finance product directed at retail investors. This is a $50 million bond listing on the social and green bond segment of the Italian stock exchange. This follows two 500 million, sorry, not dollar, but euro listings, which were positive impact bonds, which were targeting more infrastructure finance. The second area of work relates to collective action in terms of developing guidance and tools to support implementation. And then at the highest, broadest level, broader and deeper outreach engagement related to uptake in terms of framing out this framework for SDG finance. Next slide, please. So there are a number of working groups that have been established, 4 to be precise. Working groups 1 to 3 are dedicated to the implementation of the principles, and the 4th is looking at new business innovation. Next slide, please. How to get involved? Well, the objective is to inform and also to invite other banks and investors to join this initiative, either as members who are essentially in the driving seat, which are shown in blue on the slide, or supporters. And we need to engage many other types of actors along the value chain. We are open to collaborate with definitely a wide range of partnerships and initiatives in the field. Essentially, this is more, as we say, the beginning rather than the end of the process. It's the end of the beginning, definitely not more than that. So in conclusion, from prudent investment, what we see is ESG integration towards achieving positive impact finance. Within UNIPFI, we'd like to say it's a notion of changing finance and then financing change. A number of frameworks have emerged to help financial institutions to take a more proactive role in climate transition and sustainable development. Green bonds definitely being the largest and most visible first segment to move forward. And positive impact analysis is simply starting to move to the next generation of sustainability analysis that builds on existing efforts and tries to merge together essentially the positives but also the negatives. It's the green and the brown agendas being carried together. We definitely are working to support financial institutions in their ESG integration journey and believe that these principles are one next step in that direction, but also much else will be required if we are to meet the challenges of the 2030 agenda. Thank you for your attention and looking forward to further action in this area and listening now to my co-panelists.
Thank you very much, Eric, for this great presentation. I will now hand over to our next panelist, Brian Rice. Brian, can you hear me?
Yes, hello. Can you hear me?
Hello. So, yes, perfect. I think you should now be able to click your slides. You should have the comments over now.
Okay. Well, good morning, good afternoon, good evening, wherever you might be. Certainly a pleasure to be able to join everyone. Appreciate the opportunity to speak. I am representing CalSTRS with the pension system for California's public school teachers. CalSTRS has over 900,000 members and over $200 billion in assets under management. In the next few minutes, hopefully I can be able to give you an overview of how at CalSTRS we look at ESG and how we work to integrate ESG into our investment philosophy, policy, and processes. And I seem, all right, still there?
All right, it can be a bit stiff sometimes. If you try now, maybe
I seem to have lost my slides. Well, maybe can somebody advance them for me?
Yeah, I can do that. It should now be the
should we have slide 2?
Next one.
Slide 2, yes, thank you. So at CalSTRS, I would say our approach to ESG integration is two-pronged, and it's one around risk management and two around opportunity capture. So we think that ESG issues water and resource scarcity, extreme weather events, growing population. These all present risks to our portfolio, and we have an obligation to manage all risks. So certainly when we want to manage ESG risk. But we also think that investor capital can provide solutions to challenges, the need for low carbon energy, growing population, and the resource constraints associated with that, water scarcity. And so we want to try to take advantage of opportunities to provide solutions to challenges when the risk-return profile warrants it. And I would say certainly our long-term perspective, we're a fund that's 100 plus years old, influences our approach. So slide 3. So sort of turning to a brief look at the ESG integration history at CalSTRS, at least from an investment perspective, ESG investing really started back in 2004 with what was then called the Green Wave. We began to invest in private equity and clean energy. That was 2005. Later, we invested in ESG-focused managers and public equity. Next, it was engaging companies as well as fund managers and other investors and regulators all around ESG risks and the need for ESG consideration. And then later on the real estate side, we made efficiency a focus of our efforts. After that, we continued building investment capacity around infrastructure and fixed income. And then finally, most recently, we've begun integrating ESG into passive strategies, and I'll talk about these more a bit later. So moving to slide 4. So certainly ESG integration, we think, needs to occur at the policy level, and CalSTRS has had some degree of ESG in its investment policies, really going back to as early as 1978. I think today you can find ESG language in many different CalSTRS policies. So for example, our board policy manual, that talks about how ESG should be considered in investment management, buy-sell decisions. Our investment policy and management plan discusses our approach to ESG risks, engagement and divestment, and how we identify ESG risks. And our corporate governance policy provides guidelines on how ESG should be considered when we vote the almost 8,000 proxies that we consider every year. So next slide, slide 5. So despite we have a large index position in the public markets, most of our assets are actively managed. Some are internal, but most of our actively managed assets are external. And we think it's important to have sort of processes for ESG consideration there. So what we do, we require portfolio managers, internal and external, to consider our ESG risk factors. And these are all available on our website, as are all of our policies, obviously. We want portfolio managers factoring ESG risks in the decisions they make on our behalf. Our ESG risks and the duty to consider them, we put into manager agreements. And certainly we are ongoing due diligence when we meet or speak quarterly with managers. We want ESG to be part of these talks. And every year we send out requests for compliance to managers concerning our ESG risk requirements. So next slide, slide 6. So now, turning to ESG integration in passively managed assets, as you can see, most of our public equity exposure is passive. It's 1/3 of our total assets under management. So now it's like $70 billion. There's sort of a philosophy: you can accept the markets, or you can try to influence them to be better. We choose the latter. Want to be what I say active passive owners and engage market participants, mostly companies, on longer term issues, and certainly ESG issues being amongst those. There's a lot of issues that we are engaging on: majority vote standard for director elections, diversity of corporate boards and senior executives, sort of supporting our climate change risk approach is we engage companies on energy efficiency and methane capture. We're also talking to companies about water use and water efficiency and waste disposal. And it's important to us that we present what we call a value proposition to companies. So, why is it that the company should be listening to us? Where's the benefit to all the share owners? And shareholder proposals are a big part of our strategy. We think they can be an effective tool to get companies to go a little bit further. If you look back over the last 10 years, we filed over 50 environmental themed proposals and hundreds of proposals we filed on governance issues. As I said, it's trying to get companies to go that extra distance, but it's also to communicate with share owners. Like I said, we think we have a good value proposition. We think this is important for the company, but if the company disagrees, then our approach is, well, let's take it to the share owners. Let's take it to a vote. Let's see what they say. If we're wrong, we'll move on. So next slide, slide 7. Now I wanted to talk a little bit about the opportunities side, as I mentioned earlier, go into a bit more detail around what ESG investments we have in our portfolio. So as you can see on this slide, we have about $700 million in the clean tech portfolio. About 80% of that is buyout, the balance being some VC money. I think in public equity, we're doing quite a bit. We have a sustainable manager portfolio, and we're, as I said before, we're starting to move into ESG indices. The sustainable managers, they seek companies with superior ESG integration, and that ESG integration is expected to drive out performance. We've invested in the SHE index in support of our belief that gender diversity in general adds value, and we've committed $2.5 billion to a low carbon index. What we're doing is we're trying to minimize the tracking error and then optimizing our carbon exposure around that. In fixed income, we've been buying a lot of green bonds. As you can see, we have about $275 million now, but if you look back 4 years, we only had about $25 million. We're also on a couple of standard-setting boards and organizations, trying to give the institutional investor pension fund perspective on what we think makes a bond green. In infrastructure, I think that's where you're going to see most of our clean energy investments are going. This is a global strategy. It's targeting essential service assets that are operating and generating cash. And then real estate, we have a long-standing commitment to efficiency, about $3 billion in green property. This is a large part of our separate account office property portfolio, and we're pushing to get our buildings LEED or Energy Star certified. So on slide 8, please. I think it's very important to note that these ESG-themed investments we have are held to the same standards as non-ESG investments. No training wheels, no lowered bar. Also, I think it's important to note, they are actually a small part of our total assets under management, though we are, looking to grow that. And frankly, the results aren't always good, as you can see in the lower left box. Our private equity, clean tech investments have lost money. And then the table on the right, I think this slide shows, just to give you a little bit of flavor of our, some of our infrastructure and green bond investments. As you can see, in terms of infrastructure, it's mostly wind and solar, but, global exposure. And then in the green bond side, it's a mix of corporate and development bank issuances. So slide 9, that's the end of my prepared remarks. Happy to take questions when appropriate.
Hi, Brian. I'm sorry. I think we were cut for a bit, so I don't know where. I think you were talking about fixed income on your slide about ESG investment. So if you could go back from that, I'm really sorry. I think the technology.
Oh, sure. No, it just was that basically our fixed income and green bonds are really just kind of corporate and development bank issuances. Those tables were just kind of giving people an example of what we're invested in. And then beyond that was the end of my prepared remarks, and just happy to take questions at the right time.
That's great. Thank you so much, Brian, for your presentation, and sorry for the little glitch in the end. I'm now going to hand over to Frederick Samama, our last speaker. So, Frederick, you should now be on.
Hello, everybody, and I'm very happy to speak to all of you. A few words about Amundi. Amundi will be managing on Monday 1.3 trillion euros, meaning that we are the largest European asset manager and I would say the only non-US player among the top 10 world players. When we talk about ESG, we think it matters to try to have a kind of mapping of what it covers, because we think that with ESG actually there are 3 layers, and if you can keep on pushing the button, I think there is the layer of values, meaning here you don't care if you're losing returns. By implementing ESG filters, it's a way to express who you are as an investor. So if you are a Muslim investor and if you're not investing into alcohol or gambling, the question of losing returns with sin stocks is not an issue. Then you have another layer that could be named by impact investing. Here, for example, you have the green bonds. We all know that when you invest into green bonds, you have exactly the same returns than with standard bonds because there are only one issuer. But you're sending a signal that between 2 bonds, you prefer the one that will use the proceeds to finance a green economy. So here you're neutral in terms of returns. The first one, you could lose money. The second one, you're neutral. And the third one is slightly different. Here, you are thinking that by integrating ESG filters, or some of them, actually you can make returns over the long run. For example, if you invest with a company that has the right governance, that it means that over the long run, you're increasing the probability of not facing a scandal. The concrete example is this auto car maker in Europe that I will not name, but that had a very poor governance. Nobody knew that they were not saying the truth, but we knew that the governance was pretty poor. And similarly, you have carbon. Here we think that the market being short-term oriented, they don't price correctly the risks associated with climate change, and by integrating these risks, you're improving your returns over the long run. So really, we think that ESG covers 3 different layers, and today we will focus on climate change. So if we can shift to the next slide. We can say that over the past 5 years, we have seen a fascinating moment among the asset owners regarding climate change. Now, and we can say that there are 5 reasons behind that. The first one is the risk management approach. Again, more and more investors are not decarbonizing their portfolios to save the planet, but really because they think that they have mispriced risks in their portfolios. And some of them are starting with analyzing the risks, like within the Montreal Pledge, where you have 120 signatories representing $10 trillion, and some of them are already shifting their portfolios. The second reason why we had such a shift among the asset owners is the fact that new products have been created. And I'm glad that CalSTRS referred to the low carbon indexes, because technically that's a technology I will present, and we had developed with 2 asset owners, AP4 and FR, alongside MSCI. And now this technology is spreading around the planet, and CalSTRS is a good example of that. The third reason is that there is a sharing of best practices. More and more investors are hearing that their peers are doing something, and Eric mentioned this coalition that gathers 28 members representing $3.6 trillion and committing now to $625 billion of alignment of portfolios with the low carbon economy. 4 new voices have emerged. Over the past very few years, suddenly we heard the Pope, we heard central governors like Mark Carney and or journalists like Martin Wolf. And 5th, now policymakers are accelerating the process. You heard about the Bank of England, but you have Central Bank of China and so on. French Treasury is pushing the envelope as well. So really policymakers are realizing how powerful can these asset owners be, and they are trying to accelerate the process. So again, Amundi is playing a leading role. We have invented the low carbon indexes. We We have written papers on low carbon indexes, and now we are managing more than $7 billion of AUM of low carbon solutions. So on the following page, very quickly, because we are all familiar with the question, if there was one graph to illustrate that we are facing a problem, is this one coming from the NASA website, where it shows the concentration of carbon dioxide into the atmosphere over the past 650,000 years. So yes, it's up and down, but recently it's only up. And for sure, it's related to human beings. And we are all familiar with the different impacts in terms of sea level rises, global temperature rises, and so on and so on. So yes, as a matter of fact, human beings are impacting the planet and with very dangerous consequences. If we move on slides, the following slide, maybe. So now this reality is understood by more and more investors. As I say, 120 signatories of the Montreal Pledge, and you see the members. You have AP4, CalPERS, PGGM, FR, and so on. They are all analyzing now the risks in terms of climate change. Following slide. I try to stay in the time constraints. In terms of risks, we can say that there are at least two major risks. The first one is in the portfolios. The first one is, do you have in your portfolios, you investors, corporates that are polluting? We see the point with airline companies and so on. And here there is the IMF estimate that say that these polluting companies are not penalized, and even more, they are subsidized for at least $500 billion per year. So one of the questions is that a sustainable situation? And then you have another kind of risk related to the stranded assets. Here it's not about being a polluting company, but being a company that owns some fossil fuel reserves, either coal, gas, or oil. The point is very simple. 4 or 5 years ago, Carbon Tracker had a very simple idea. All these corporates, their valuations are based on the reserves. And the question is, can we take all these reserves and to put them into the atmosphere for the next 100 years? Concretely, the proven reserves are representing 2,800 gigatons CO2, 200,000 gigatons. And if we want to have an 80% probability of not exceeding more than 3 degrees, actually the budget of the planet is only 1,400, out of which we have already burned 300. So we are maybe using figures to evaluate BP, Shell, Total, and the others at 2,800, when the budget is only half of that. So there's a risk that all these corporates are actually overvaluated. So here you have two risks. But what is interesting is that most of the investors were facing the problem of the time horizon. The question is, fine, maybe I have risks, but when are they to materialize? And what can I do in the meantime? So here is coming financial innovation to help tackle the key question of the time horizon, or the tragedy of the horizon, to use the terms of Mark Carney. Following slide. So that's why we developed our first prototypes with AP4, and then we developed mainstream products with FR and alongside MSCI. We have developed carbon leaders and actually carbon tracker, carbon target that CalSTRS is using. And the idea is really to decarbonize portfolios, indexes, meaning that we can reduce the risks over the long run without changing the market exposure over the short run. So that means that we take a portfolio and we will exclude the worst performers without changing the sector or country allocation. So we can reduce the risks with a low tracking error. And the good news is that it has worked pretty well. If we do some back testing, you see the figures for the whole North America of Europe, you have outperformances of more than 35 basis points per year. And the concrete investment that we started in November 2014 for FR has delivered a 60 basis point of outperformance per year over the past 2.5 years. So that means an information ratio of 0.65. So yes, we are decarbonizing the portfolios, and yes, it's delivering some outperformances, stable and concrete performances. Next slide, if we can. As Eric said, we are one of the 4 founding members of this platform of sharing of knowledge that now includes 28 members, including US players, corporate pension funds, insurance companies, pension funds, sovereign wealth funds, and so on. And the idea behind that was to say that we had observed that investors were developing some solutions, but they were all doing that on their own. So we said that it was making sense to create a platform where investors could share their knowledge in order first to accelerate the process, and second to send a signal to the others that yes, it was doable, it was scalable. And so, as I said in my introduction, we had an initial commitment or objective of $100 billion, and I'm glad to report that as of today, we have $625 billion of commitments of aligning portfolios with the low carbon economy, out of $3.6 trillion, meaning 20% of the assets. Following slide, if we can. The fourth reason was, I mentioned in my introduction, the fact that you had new influential voices. No need to be long on that. To take one concrete example, the first encyclical published by Pope Francis on June 2015 was on climate change. And it was a very strong signal. First time a Pope published an encyclical, and this Pope chose that topic as being the first topic for his first encyclical. And before that, he had gathered specialists for years in order to make his own opinion. Next slide. Now, what we can say as well is that policymakers have realized how powerful the mobilization of asset owners could be. Concrete example is in France. In France, we passed a law that is named the Article 173, that say that all investors, meaning pension funds, asset managers, banks, and so on, must disclose a couple of things. The first one is their ESG footprint. The second thing is their risks related to climate change. And the third one is how they are contributing to the low carbon economy. It's pretty powerful because actually the French government did not decide to publish some standards. So all players have to set up their own ideas on that. So it's creating a kind of Brownian process of ideas. And there's a kind of competition between the players to have the best analysis. And what is very cool as well is that it covers everybody without being mandatory. It's more a kind of you must do it, or you must explain why you don't do it. But the point is that while we had a few players doing something, now it's spreading the word among all asset owners. And interestingly as well, these asset owners have asset managers abroad, and now the pressure is on the asset managers being all over the planet as well. So one decision being taken by the French government is actually spreading the word around the planet in terms of risk analysis and how to contribute to the low carbon economy. So now just to conclude with the next slide, I would say that is no next slide. I would say that if you take the Carbon Disclosure Project that gathers all the asset owners that are already being interested into climate change, they represent $100 trillion. That's the size of the signatories behind Carbon Disclosure Project. And it says a lot. It says that if only 0.1% of all these asset owners around the planet are analyzing their risks, are using products being already developed, tested, and so on, if only 0.1 is shifting from being interested towards taking action, then we have a $100 billion reallocation from polluting companies towards green companies. So 0.1% of 100 trillion is $100 billion. So that's why policymakers are getting so excited about this new mobilization, because they see how powerful asset owners can be on that question. And without changing their fiduciary responsibility, just by doing their very basic job, that is to assess risks, and when they come to the conclusion that they are mispriced, to sell them. And for that, again, they have the examples of their peers, they have products, and they can just continue the journey. Here I'm stopping.
Thank you very much, Frederic, for your great intervention. We're now going to go on to the Q&As from our listeners. We have received a lot of interesting questions, so thank you so much for your interest and involvement. I guess kind of like the first question would be addressed more to you, Frederic. You mentioned the new policy in France and, for example, Amundi's low carbon indexes. Are there any standardized, like globally standardized tools to help companies disclose on ESG issues?
Not yet, and it's normal. It's still a work in progress. I think we must be all humble on ESG and climate change. I refer to stranded assets. That is a very popular topic. But actually, it's only 4 or 5 years ago that Carbon Tracker got that idea. So my point is to say that it's still work in progress, and it's normal. And so we have to be humble and to recognize that and allocate resources in order to accelerate the process.
Yeah, great. So how would you say investment managers can help to increase their capabilities to incorporate ESG issues?
I think it's first the asset owners must ask their asset managers how they are doing that, how they're integrating this risk. For all asset owners having time horizons that are exceeding 2, 3, or 4 years, it's making a lot of sense. So asset owners should just ask their asset managers, how are you integrating long-term oriented risks? And again, if a company has a bad governance, the probability to fail is higher than for a corporate having a right governance. So it's in the mandate. The asset owners should integrate that in the mandate they're giving to their asset managers. And they're doing that more and more. The concrete example is GPIF. The Japanese giant, $1.3 trillion, is now integrating that criteria in the mandates on a regular basis.
Yeah, great. Maybe Brian, you wanted to ask something, add something on top of that.
Yeah. So, in terms of is there a global tool around sort of ESG disclosure for a company? It's not. In the U.S., the Sustainable Accounting Standards Board, SASB, is working to develop standards for ESG disclosure based on materiality, and it's something that we've support. We've helped to develop, and it's really, I think it's a really good approach. I know, having been involved in ESG awareness and disclosure, there's a lot of different providers out there in terms of data and ESG rankings and a lot of different standards in terms of disclosure. And what SASB is trying to do is, again, focus on, okay, what are the material issues by sector, and it's bringing in investors and managers and companies and trying to come to a sort of an agreement amongst everybody. Okay, what is it that companies in particular sectors need to be reporting on? So we're hopeful this is something that at least can get traction in the U.S. and then globally. And certainly in terms of managers, Frederick's exactly right. It's up to asset owners to be driving this, and that's something we believe at CalSTRS. And as I alluded to in my presentation, is what we try to do is to let them know, okay, we think ESG risk is important. Here are some examples of the risks, and try to have a conversation with them and challenge them to be thinking about it too. And we've seen that there is some traction. We've seen managers sort of going out into the market saying, okay, how can I get help, analyzing ESG risks because, my clients like CalSTRS are asking me to do this.
Yeah, of course. And actually, we got a question from one of our listeners on Twitter who is asking if CalSTRS have any kind of recommended approach to external managers in terms of ESG integration practice and reporting.
I think it's, like I said, as an owner, you need to be aware of ESG issues, and I think you need to have an understanding even of what you think, ESG risks are and how they might manifest themselves, for companies based on sector and regional exposure, et cetera. And then it's continuing to, push the managers, and certainly, okay, where are you, how are you incorporating this into your, portfolio analytics and your philosophies, and, examples of sort of where ESG is influenced, buy-sell decisions. And I'll tell you, it's a process. I mean, it's something that we began many years ago. Some resistance at first because we've had a lot of long-standing relationships, and suddenly it's, well, what's this ESG thing now you want us to be talking about? But I think when you take an approach that's reasonable, sensible, it's about value and better returns, and saying, look, we're not, we're just asking you to manage risk more broadly. And it doesn't mean that there's always going to be an environmental issue, there's always going to be a social issue, there's always going to be a governance issue. We just want you sort of aware of what the issues can be looking at them, and identify the appropriate ones when you can.
Yeah, of course. And another question was around technology. So, of course, it's one of the main investment risks that are associated with climate change. So how do you stay up to date about kind of the speed, scale, success of low carbon technologies of existing sectors, or even the development of new sectors?
I guess I just, you've just got to be sort of, following, news, following information, I'm very involved in, a variety of working groups, and I go to a lot of conferences, and I get a lot of news feeds, so I think certainly technology is something that we're trying to keep on top of. We were part of a Mercer climate change asset allocation study, and which developed some risk factors around climate change, and one of them was, okay, technology and how technology advances is largely going to impact sort of the response to climate change, and therefore, price on carbon and all those other ramifications. So it's, it's important to keep up on that. It just really is, tapping into all the resources that are out there, and educating yourself, and not necessarily relying on others to kind of tell you what to do.
Yeah, of course. Maybe, Frederick, did you have anything to add to that?
Yeah, I think on this question of green, for many years, investors have tried, I would say, the positive side, to identify the right technologies and so on. It has been very, very complicated, because it's not so easy to decide if you must invest into wind energy, solar energy, which corporate. It's very much related to incentives given by governments, and it's quite unstable around the planet because it depends a lot about politics. So for investors, it has been a very challenging task to make the right, I would say, positive investments into the green economy. By using the other approach, by assessing the risks, it's slightly easier, because it's slightly easier to identify which players could be the losers of the low carbon economy, the ones that are not very well prepared. And by doing so, investors are kind of learning better the challenges that corporates are facing. And by having this learning, they are slightly better prepared to make the positive investments. So you see, before it was only about trying to identify the winners, but by trying to reallocate to pay more attention to who could be impacted, then it helps the learning process that is necessary due to this, the complexity of the task.
Frederick?
Yep. I just stop. Pierre, stop. Did you hear me? Hello?
For a moment, maybe we'll wait until it comes. Frederic, is that you?
Yep, I'm here. So
Okay.
I don't.
Perfect. I think.
Yeah, I'm here.
Please go ahead. You were saying.
Oh, sorry, I don't know. Sorry, I don't know if you heard me. In a nutshell, I said that for many years, investors were trying to identify the winners of the low carbon economy. To make a long story short, but it was very complicated because you had to choose the right technologies, the right players, and very much related to incentives given by governments. So it was challenging. With this risk approach that has emerged recently, it's slightly easier because it's slightly easier to identify which corporates could be impacted by the low carbon economy, which ones are well prepared to face this major shift. And so by doing this very low-key pragmatic approach, actually it helps the learning process for the investors. So it's not to say that they are abandoning the search for the winners, but by focusing as well on what we could name the losers, it helps the process of learning about this low carbon economy.
So there are some ESG ratings that company can get. Can you explain to us a bit about how can companies improve on these ESG ratings and kind of attract investors more easily?
Well, yeah, there are plenty of ESG ratings. Either you have ESG ratings providers, or the asset managers are beefing up their teams. For example, at Amundi, we have 18 dedicated people. So they are buying the different databases, but they are doing their own analysis as well. And so the bottom line is that now we are implementing ESG filters for 95% of our assets. That's huge. So it covers equities, fixed income, real estate, private, everything. And now to your question, how corporates can improve? Just by improving their policies, by having well-diversified boards, by taking action on their emissions, by playing on diversity, and so on and so on. So it's just the regular life of a corporate. An ESG filter or ESG rating at the end is about, as the company, a sustainable activity. If you're polluting one, that means you're at risk because eventually the corporate will be penalized. If you have a wrong governance, that means that when you will face a crisis, the probability to react well is lower than for a corporate having the right governance. So, an ESG filter or an ESG analysis can be perceived as a way to assess if a corporate has a sustainable business over the long run. And over the long run means a lot. If you're short-term oriented, it doesn't make sense to pay attention to ESG. But if you invest for the next 3, 5, 10 years, like a pension fund, sovereign wealth fund, or insurance company, it should be just part of the usual business of assessing if a corporate is a good bet or not.
So we have time for. Oh, sorry. Go ahead. Sorry.
No, I was going to point. I think having looked at ESG ratings on companies for a long time, I think it sort of comes down to one, action and disclosure. So certainly companies need to be telling the story about how they're minimizing their impacts on the environment and how they're aware of how the environment might impact them, extreme weather events, sea level rise, et cetera. Certainly from the social side, worker health and safety and community impacts are big, and you always want to have a good, governance structure. But the other thing that a lot of companies aren't doing is disclosing that. And so what these ratings do is they try to reach out to companies, but they look at sort of what the company's disclosing on their websites and their filings, and when they don't see things, they get bad ratings. We do our research, see these companies with bad ratings, reach out to them, and it turns out they're actually doing a lot of things a lot of the time, and they're just not disclosing. So action and disclosure, I'd say.
So one last question for you, Brian. There was from one of our listeners as well. And has Casters made any attempt to coordinate its efforts with other pension funds with parallel member interests?
We do a lot of collaborative engagement, both in the U.S. and globally. So in the U.S., we collaborate with, the New York City, New York State, CalPERS, Florida, Connecticut, most of the big pension funds, in fact, all the pension funds that are active on ESG issues, working a lot through series. We're also part of the PRI, so we work collaboratively globally with the APGs and PGGMs and RailPen and USS. We're an ICGN, International Corporate Governance Network, ACGA, Asian Corporate Governance Association. So we're working with the GPIF, trying to help them in terms of their ESG integration. So certainly collaboration is very important to CalSTRS, and we're very involved, we think, on a U.S. and a global scale.
Thank you very much, Brian, for your answer. Well, we're getting to the end of our time, so thank you very much, Frederick and Brian, for taking part in this panel and share your experience and knowledge of ESG strategies and investing. Thank you, everyone, for attending this webinar. You will receive an email with the recording shortly, and a write-up will be published on our website. So have all a very good end of the day. Thank you.
Thank you to all of you.